In December 2001, a U.S. corporate giant ranked 7th in the nation collapsed overnight, wiping out $63 billion in wealth and erasing thousands of retirement accounts. Wall Street traders stared at the bankruptcy notice on their screens in stunned silence. What shocked them wasn't why the company failed, but that until the very second it died, no one could explain it. No one knew what this $63 billion company actually did to make money. Welcome to one of the most absurd magic shows in business history. Today I want to unpack a strategy called narrative arbitrage. In this game you don't need roaring factories or even a single screw. All you need are a few polished slides and a bold story. A story bold enough to hypnotize your audience. The company was Enron, and before it went under, it was highly praised. Named Fortune's most innovative company in America for 6 consecutive years. Its headquarters was filled with some of the brightest minds in the country. And its financial statements looked like absolute works of art. But if you stopped any sharply dressed executive in the hallway and asked the simplest question a child could ask, "What exactly do you sell?" they would shrug, drag you to a whiteboard and spend 40 minutes talking, drowning you in industry jargon before mysteriously telling you a secret. "We don't sell natural gas, we sell the future of energy." It was this intangible future that allowed them to package a dull pipeline company, disguised as a Silicon Valley tech giant, fooling auditors and savvy investors alike. Stock prices soared, everyone was celebrating, and no one questioned the hidden truth. Until one night at 2 a.m., a new employee opened a hidden internal ledger. The cold stream of numbers on the screen pronounced a death sentence. It revealed a chain of failures that would make Wall Street veterans shiver. The collapse of $63 billion wasn't triggered by a sudden market shock. From day one, the towering edifice of wealth had not a single real brick. In 1985, Houston smelled of oil and rust. Enron was then a barely surviving natural gas pipeline company. Its daily job was to maintain thousands of miles of heavy iron pipes, transporting natural gas from one end of the country to the other. Work as cumbersome as an elephant, earning only a few cents in profit. Outside of the IRS accountants, even Wall Street elites barely gave it a glance. Until Kenneth Lay appeared with an economics degree and sensed a subtle breeze. As government oversight loosened, a massive arbitrage opportunity emerged. Lay made a cold, brilliant decision about the cumbersome gas transport. If transporting gas is cumbersome, why stick to being a mere carrier? Let's stop being the carrier and become the dealer instead. Jeffrey Skilling, a McKinsey consultant, was recruited with an absolute fortune. Armed with spreadsheets and Wall Street hunger, he fundamentally restructured Enron. The natural gas that once flowed slowly was stripped of its physical form. It was turned into highly tradable financial contracts. Enron was no longer a utility company, it became a Wall Street casino. A massive casino hiding in a cheap energy costume. Standing in front of hundreds of investors, Skilling tossed up a slide. "We don't sell energy, we sell the future of energy." Like a magic spell, it hit the exact nerve of Wall Street. Heavy steel pipelines were discarded for a new vision. Enron transformed its dirtiest assets into the sexiest financial bubble. Stock prices skyrocketed, and everyone was living the fantasy, earning tens of millions with just a few simple clicks. But in a corner of the trading room, a report exuded a nauseating chill. In this flawless financial magic show, one fatal flaw quietly tore through the web. Turning dull gas into wild financial bets required hunting for ever larger numbers. Traditional trades couldn't satisfy Wall Street's insatiable appetite anymore. The company pressed the button that would accelerate its own death. They decided to dress up as a shiny new tech company. Skilling tossed the muddy pipeline diagrams straight into the trash, repeating that they don't sell energy, they sell the future. During the internet bubble, traditional utility companies had low price-to-earnings ratios. Tech companies, even with consecutive losses, could see valuations absolutely soar. Skilling knew Wall Street's biases, so his task was wrapping Enron in buzzwords. And so Enron Online was born as a digital energy trading platform. Millions of tons of natural gas contracts could be traded instantly. It was as easy as ordering a late-night pizza. Ask any executive what they actually sold, and they wouldn't show you the books. They'd drag you into a meeting and bombard you with buzzwords. Words like market making, decentralization, and digital innovation for 40 minutes. You wouldn't understand, but seeing the stock chart climb, you'd nod. You would just nod your head and hand over your money. With slick slides and tech speak, Enron became the most innovative company. Analysts poured valuation premiums straight into this empty shell. The spotlight grew brighter, and Enron's market cap swelled to $63 billion. But if you snuck into the finance office at night, the truth was chilling. The smartest tech giant in America couldn't even produce a dime in cash. The reason it could dominate the world was cruelly simple. When a financial report can make everyone rich overnight, human greed constructs an impeccable logic around it. As long as the stock line kept climbing, a hollow shell could be worshipped. It wasn't just a management scam, it was a collectively willful blindness. Fortune kept crowning it the most innovative company, and journalists camped outside. Analysts partied, unconcerned about real business as long as they got commissions. Employees lived under Darwinian pressure: bring profits or be crushed. Red eyes, overnight spreadsheets, backstabbing colleagues, the frenzy was relentless. A single glance at the real bank account could make you tremble. Reported profits in the tens of billions, yet the cash was nearly gone. Why did everyone turn a blind eye? As long as the Wall Street party continued, massive dividends would still arrive, even if they were drawn from ordinary employees' pensions. But the shelf life of a lie depends on the last drop of cash. In the winter of 2001, reality mercilessly tore the veil apart. A company without cash flow is doomed at the first debt default. In weeks, the $63 billion giant completely collapsed. Thousands of employees cheered their growing stock accounts the night before, only to wake up and find their desks gone and life savings wiped out. Wall Street's elite had packaged a mediocre pipeline company as a tech deity, a deity with absolutely no tangible product to sell. In this world of illusions, the survival rule is brutally simple. Never pay for a business story you don't understand. If a founder lectures for 40 minutes and you still don't know, if you don't know how the company makes its first dollar, close your wallet and walk away. History never repeats exactly, but it often rhymes. Look at today's hype around AI, large language models, and disruptive startups. How many are replaying the same illusion from 20 years ago? Open your trading app or think of your latest tech obsessions. Which high-valuation, hyped-up companies are the true hardcore survivors? And which are fragile paper houses ready to collapse when the cash stops?